This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Need help in finding investors for your startup, fund, or angel group? 10 Capital provides funding as a service helping you find accredited investors. Contact 10 Capital to gain access to investors for angel and venture capital funds, family office rounds, and syndication raises. To learn more, go to 10capital.group. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Neetu, Puranikmath, investor at Chisos. Chisos provides alternative financing for founders at the earliest stages and fills a massive funding gap by connecting underserved founders to capital sources. Neetu, thank you for joining us.
Thanks so much, Hall. It's a pleasure to be on this podcast.
Great. So tell us more about your background. What were you doing before you started investing in early stage companies?
Yeah, so before I started investing in early stage companies, I worked as an operator. I was part of the YouTube operations team, Google operations, as well as Facebook media operations team. Then I went abroad to England to complete my MBA, did an MBA in corporate finance at Oxford. And there I got really interested in emerging technologies, specifically AI and blockchain research. And this was in 2017, 2018. I did a really cool research project on how AI was disrupting the fintech industry and influencing algorithmic trading. And that led to my continued interest in fintech. Post-graduation, I interned at a few VC funds, was exploring the accelerator space, but my AI research led to me being chief of staff for a fintech startup that used to have an American office, had a London office as well. They were in their process of shutting down the US offices, moving everything to Europe, and they needed someone to kind of come in, cross-functionally work on various projects and help them through, the post-Series A scale-up period where they were having a few growing pains.
Great. So what excites you right now?
I think, continuing off of the research I did during my MBA and my past experiences, I continue to be interested in emerging tech trends, especially fintech, innovation in AI, machine learning, how it intersects there as well. I've always also been interested in the real estate sector. I wrote a paper about how blockchain was, at the time, I thought would have a huge impact in real estate tech. It's not been the case, but who knows? Maybe my thesis will end up being correct in 5-10 years. And I think more recently, and specific to venture capital, I've been really interested in alternative investment asset classes. And I think, with COVID-19 and with a lot of Americans being remote workers, everyone's kind of having a bit of spare time, looking for ways to diversify their portfolio. And I've really seen an uptick in alternative investment assets. Friends who don't know anything about venture, startups are interested in NFTs and are buying NFTs. And I think that this proliferation within the market is leading to a whole new class of potential software platforms as well that will help with these investments and the distribution of these asset classes, as well as diversification within the venture industry as a whole. And the diversification of the venture industry, I would say that's kind of where Chisos also comes into play. So Chisos invests in founders at the earliest stages, often pre-revenue, often even pre-traction, pre-MVP. So it's often the first check-in for these first-time founders and functions as an alternative to a friends and family round. And I think, a platform like Chisos is relatively new. And there weren't really these sorts of platforms or these options that existed for entrepreneurs 4 or 5 years ago. And I think part of this is just the trend of, venture changing.
Great. So you see a lot of startups and a lot of investors in what you do. What's your advice for people investing in startups? What do you tell them to do before they write that check?
So I'll speak to early stage startups because that's where I have the most experience in. And I think one thing to remember about early stage startups is you're investing in the team, you're investing in the co-founders. And this is something that my operator experience and my experience as a founder also points to this. There will be many pivots and iterations of products. Products can shift and change and, can even be tweaked. And the focus of a company can grow and evolve. Look at Google now and look at what product Google came out with, for example. But I think what's really important, especially for smaller teams, is to make sure that all the founders are aligned on their vision, that there is as little co-founder friction as possible, and that there is trust within the founding team. Co-founder breakups can be really, really harmful, and there are really strong risks. So I think, one thing I do is to evaluate how long founders know each other, who the early employees are, what sort of experience they have, and if they have experience building and developing. Even first-time founders can have experience building or iterating in a particular space. And what we're really looking for is that founder market fit, that strong competitive edge that shows this team is a winning team. And here are, 2 or 3 reasons why they're better than most of their peers for this particular project in this particular market.
Great. Then on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise that first round of funding?
So fundraising is, it's a marathon, not a sprint, is one thing I would say. I would also say that if you think you need a runway of 6 months, make sure you've fundraised for 12 months. It's always good to have more rather than less. I mean, you can't predict certain market conditions. For example, COVID was really hard to predict and impacted a lot of small and medium businesses pretty negatively. And I think also there's a phenomenon, which is the post-seed or, post-pre-seed funding gap and the death that occurs there for a lot of startups. So a lot of startups, they get their first check and then they're unable to kind of clear the hurdles that they need to reach Series A. So my thing would be, don't be afraid to shift your product focus if necessary. Do a lot of pilots, do a lot of testing, test and iterate on your hypothesis. Have a team that you can trust and work with, especially your other co-founders. Try to make sure you're all mission aligned and that you're aligned on your goals and vision as well. If you don't have that much experience in a certain area, if there's 2 non-technical founders or if there's a non-technical founder, make sure you surround yourself with people who have that expertise. Hire, really experienced devs, have advisors that have experience in this sector.
Great. So let's talk about the state of startup investing. How do you see the industry evolving from here?
Yeah, so I think, especially if you look at 10 years ago and now, I think the Series A valuations from 2010 are kind of where the seed valuations are now. And the Series B valuations are kind of where the Series A valuations are now. And that kind of goes to show that, again, we're seeing 25 mil, 30 mil valuations for seed companies. And I think, I do think that this is a bit of a bubble and that this overvaluation is a trend for better and for worse. I also think that the industry and venture is something that a lot of different people are trying to get into. And what I mean by that is we see that in the creator economy space and with a lot of consumer VCs and consumer angel investors, especially in places like LA. There's a lot of celebrities and a lot of ultra high net worth individuals who might be from the entertainment industry, the sports industry, et cetera, who are now seeing the value of venture as an asset class and returns and, either are LPing into funds or are trying to start funds, become angels and invest in the space. And I think we didn't really see that as much before. And I recently, attended a really cool conference where there were a lot of former athletes that were looking to basically put a lot of their money into venture versus the stock market. So I think that's pretty interesting. And I think that's pretty cool. I also think that there's more emerging fund managers. There's a lot of micro funds and sub $20 million funds as well. And I think there's greater interest in US firms investing in emerging markets, whether that's Latin America, Africa, especially for fintech. That's something that I noticed, in my past as an investor, I sourced and led to African fintech deals. I was working on a lot of Latin American fintech deals. And I think now that risk can kind of be quantified in certain ways, or the risk reward is seen as being, the reward is worth it. American firms are looking to invest globally, more globally than they were before.
Great. Well, let's talk about your investment thesis. What exactly is it and what's your criteria for investing in a startup?
Yeah, so I'll talk about Chisos and then I'll talk about mine as well. So to begin with Chisos, I think Chisos invests at the earliest stages, sector agnostic, often first check-in, allowing to safely invest in impact. And I think something that's super cool about Chisos's model is that, early stage startup founders don't have that much funding options. No bank will extend credit in these early stages. The majority of Americans have less than $1,000 in savings, and many are unable to self-fund. Institutional investors, even at the pre-seed and seed stage, want to see customer traction, a developed MVP, and a realistic business model. And I think what Chisos really allows to happen is it provides a platform that connects capital sources of municipalities, universities, foundations to local founders. And the key differentiator is it has a proprietary CISA, or convertible income share agreement. And the CISA is a hybrid financing vehicle. It essentially combines a personal income share agreement with the founder and a small percentage of equity in the business. Chisos' model gives the client the full control over the structure of the unique investment vehicle. And it provides flexibility in non-dilutive terms to the founder and downside protection for the investor. So ultimately, what this all means is this model enables us to invest in startups that are too early for other investors, or startups that don't fit the hyper growth model required by most VCs, in addition to more familiar startup models. And I think it's really interesting, especially with my background in institutional investing, because, when I was working at an institutional VC fund, we cared a lot more about like MRR, like month over month growth. And there was like very strict metrics that you have to like hit, even if you're looking at the pre-seed and seed stage, because otherwise it was too risky to make these bets, right? And I think with Chisos's model, early stage ventures are seen as high risk and high reward, but we're still able to safely invest in them. So that's something that's a little bit different about Chisos and kind of about them. And I think for me personally, as an angel investor, or just as an investor, like separate, pretending that, say I had $100 million fund or something like that, I think my investment thesis would probably be centering around fintech and SaaS, general SaaS and fintech, because that's where I have the most experience in and the most knowledge, both in operations as a founder and as an investor. Probably to start off with 80-20 split, 80% focus, or maybe I should say like 80% focus on the US and 20% split Canada and other emerging markets. And I think my investment thesis is to kind of find those underserved, gritty founders in areas like I mentioned, like Kansas, North Carolina, the South, the Midwest, and to really find these hidden gems. For a couple of the deals I've sourced from these regions, I was helping them fill out their cap table and sharing with my institutional venture friends, and they weren't that interested. They were like, oh, well, this company is in X small state, I'm like, how are they going to be able to find tech talent? And I think, again, with the pandemic and with a lot of the tech and developer jobs going remote, that's no longer really a concern. Even if a founding team is based in Kentucky or, Montana or wherever, they don't need to have a dev team that is from that region, right? Like, the dev can be based wherever else and can be working for them. So yeah, I'd say my investment focus is helping these underserved founders and founders from these emerging markets within the domestic US, connecting them to capital sources, helping them upskill, and helping them plug in the gaps that they might have in their network to help them get to Series A.
Great. Well, you see a lot of startups and investors out there. What do you think is the main challenge startups face today when they launch their business?
I think differentiation. I think a lot of sectors are super saturated. And I think that there's a lot of different startups trying to do the same thing. Like there's a joke that if you go to a bar in San Francisco and, you toss a coin, you will hit someone who is either a founder or who is an investor. And I think there's a lot of founders that don't get the initial capital they need to grow. Some founders are blessed enough that they can have a friends and family round, or they have a really strong alumni network from where they went to university. Other founders, such as the founders that I think Chisos and I really like to target, might not have the benefits of, that strong network of a Berkeley or, a Vanderbilt or like an East Coast school. And, getting them to be able to find that initial capital can be more difficult because it's kind of like, which comes first, the chicken or the egg, like the traction and the pilots and the MRR, or like the capital that allows a founder to develop the MVP so he or she can have a pilot, right? So I think that's a major issue people face. And I think the second issue that I've noticed is, again, with companies that are overvalued or the valuations are too high, when they're raising their next round, like you have a seed company who has a 25, 30 mil valuation, and now they're raising their A. The A venture capital funds want to see a really high MRR and ARR because their seed valuation was so high. And oftentimes the founder can't really make that with the runway that he or she has left. And I think in that situation, that's when you see seed 2 rounds or like bridge rounds or things like that. Or, sometimes companies not making it to the A because they're not able to clear those hurdles.
Great. And then on the other side of that table, what do you think is the main challenge your investors face in today's market?
So I think, especially with the context of emerging fund managers and smaller funds, I think there's a lot of new VCs out there. And I think branding and differentiation, right? Like, why is this smaller VC fund or mid-sized VC fund different from all the other ones that are out there? And how can this particular VC provide value? A lot of people say, we have really great networks, we have past experiences that, provide that we're an expert in this particular niche sector or across sectors. And that's all well and good, but there's, I don't know, like 50, 60, like a ton of people who say the same thing in the Valley. So I think having an investment thesis that is unique is critical and key, and also being able to show that you can provide value to founders and being very founder friendly. And I think, my past experience as a founder, as well as the Chisos team is all like ex-operators who have experience being in the founder space. And I think that makes us very founder friendly as well, because we understand the struggle. We've been, as an operator, working in a startup context, and we know how to provide value immediately when we're working with founders. And I think that's important for investors to do.
Great. Well, you've talked about a lot of different sectors and applications and see a lot of them out there in the marketplace. If you had to pick 1 or 2 that you think are really good opportunities for investors to pursue, what do you put at the top of the list today?
Yeah. So I think I would say if you're able to, I would say emerging market fintech, either domestically or internationally. I would say fintech is a sector that is always doing relatively well and always has a consumer base of some sort. B2B fintech especially, banks, other sectors will always need innovation, and that's something that is continuing to grow. Hasn't really seen too much of a downturn. In the UK, I noticed a trend for neobanks, but it hasn't, when I was living there, but it hasn't really passed on for the US. So I would say fintech in general. I would say finding fintech valuations that are below 10 mil, if you're able to, at the seed, and finding those earliest fintech deals. Like when you're able to get in before Sequoia, before a top VC fund, when you're able to get in early for a valuation that's, below 5-6 mil, I think that's when you can see the biggest upside. And the way to do that, I would say, is to expand your network, attend panels, attend events that are for a certain fintech sector that you care a lot about. For example, if you're interested in AML, anti-money laundering, know your customer, attend those. If you're interested in B2B fintech SaaS, there are events for that. But I think it's important to immerse yourself in the industry, know other investors and know other founders, but don't rely on VCs to pass on deal flow necessarily, because, often those aren't the super early, very competitive deals. And I think deals also get very competitive the more funding they get and as they pass along the pipeline. So I think if you're trying to break into the space, become an angel investor, try to find those hidden bets in regions that people aren't focusing on, and try to find a way you can add value.
Great. In the last few minutes here, let's talk about alternative financing options in the early stage ecosystem. What do you see out there today?
There's a lot of next generation capital funding platforms. So Chisos is a CISA, convertible income share agreement investment platform based on the whole ISA model, which, again, to touch on briefly, ISAs are about investing in an individual's future success, right? And ISAs, income share agreements, have historically seen significant returns in the education sector. So we are using this instrument to de-risk early stage investing and get capital in the hands of very early stage entrepreneurs. So that's a CISA investment platform. There's also investment platforms in general, like AngelList Venture, Micro Ventures, Altvia. There's crowdfunding platforms, and you see that with like Republic, WeFunder, Start Engine. Revenue-based financing, like Clearco, formerly Clearbank, now is about like $2 billion valuation and has seen a lot of success with that. Pipe as well. And, targeted debt portal options as well with like Upstart and Zinch. And I think, looking at crowdfunding, I think crowdfunding is a way to kind of bring investing to the masses, especially with like Republic and WeFunder. The stage and focus, I would say, is like revenue and product. So it's a bit further along than Chisos would be. And funding size is typically, $250K to $1 million. So it's a bit bigger as well. And the business model is percent of the raise. So I would say that's something that, is pretty interesting. And if someone's looking to learn more about next generation capital funding platforms, alternative funding, like vehicles, I would recommend like not only check out Chisos, like, Chisos.io, but also look at, crowdfunding platforms and look at investment platforms like AngelList Ventures and Altvia as well. I think there's a lot that's changing, especially in the past like year and two.
Well, that's great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Yeah, I mean, I'm curious to know about like what sector you find most compelling, I guess, for 2022. Like if you were giving advice to me or, other angels on an area to focus on.
My thesis is that everything is moving online. I mean, everything is moving online. And so you want to look at what's transitioning now into an online model. NFTs are, an instantation of that, where you're putting online a piece of art or music or something else. You're seeing a lot of interest in that coming up, and it's at the very beginning stages. Blockchain, we looked at back in 2017. It was, the world of ICOs and white papers and a lot of insanity going on with it as well. But today, here we are 4 years later, and you're seeing some substantial networks being stood up and meaningful applications coming through, and new ecosystems around decentralized finance called DeFi are coming into focus. And so we'll see a lot going on in that space as well. And then you're also looking at fintech. It's, I think you're right. I think one of the hottest spaces out there now is alternative funding and financings and alternative fintechs. And if you look at regulated industries like financial and healthcare, they're, because of regulatory and inertia and other reasons, they're the last to move to the next generation of technologies. And that usually means there's going to be built up or pent up demand, and there's going to be great opportunities to profit from the transition when it happens. As Ernest Hemingway says, it goes gradually and then suddenly. Well, so will be the switch over to new things like crypto and NFTs and blockchain and other applications out there. And we're seeing a lot of interest and demand coming in those areas. And I find this round, relative to the last round with blockchain in 2017, I found many of my investors just didn't want to engage with it. The signal to noise ratio was just too out of whack. It was just too hard to find a good deal in all the insanity that was going on. But today, everybody's starting to engage with it. They're starting to be a part of it, and they're going to do something with it. So I think we'll see meaningful funding come in on this next round with the alternative financing, especially around the crypto side of it and the blockchain side of it. So that's what I'm seeing out there.
No, that's amazing. I really agree with you. I do think, we're having a wave of everything moving online for both ease of convenience, as well as, the distributed workplace as well. And especially with remote work, like everything is possible to do from an internet connection. So yeah, completely agree with you. And I think that's a pretty cool thesis.
Right. So how best for listeners to get back in touch with you?
Yeah. So I think if you're interested in contacting me, Neetu at chisos.io is a great way to get in contact with me. I check my email all the time. And yeah, looking forward to hearing from hopefully some of you.
Great. Well, I want to thank you for joining us today. We'll put those in the show notes and hope to have you back for a follow-up soon.
Thanks so much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.